in respect to, with respect to capital market theory, which of the following asset characteristics is least likely to impact the variance of the investor's equally weighted portfolio? Very, very, very easy question. Please read the question again. With respect to capital market theory, we know that capital market theory we can calculate the different numbers: mean, standard deviation, weights, covariance, correlation. So he's talking of that which of the following asset characteristics can have different features. These are the characteristics. Mean is a characteristic of an asset, standard deviation can be the characteristic of an asset, weight is a characteristic of an asset, and the relationship between two assets is a characteristic of an asset. So which of the following least likely, you have to underline the least likely because the question is in negative sense, to impact the variance of variance. It means the whole square of standard deviation. It means standard deviation of a portfolio, and we know that in standard deviation of a portfolio, what is the formula for that? A plus B whole square into correlation into RAB. I have told you under the root. That is standard deviation of A whole square, weight of A whole square, plus standard deviation of B whole square, weight of B whole square, plus 2 standard deviation A weight, standard deviation B weight, B into correlation between A and B under the root. Now see in this formula. Now the question is, which of these variables are least likely affecting the risk of a portfolio? Variance will affect, standard deviation will affect, correlation will affect, covariance will affect, but return will not be affected. Return will not affect the variance of a portfolio. So first point is return on the assets. So return on the assets. So the same thing I have written, variance or standard deviation of a portfolio is affected or can be calculated. This is affected or can be calculated as follows. Standard deviation A whole square, weight of A whole square, plus standard deviation B whole square, weight of B whole square, plus 2 standard deviation A weight A, standard deviation B weight B into correlation between A and B. So now from the above formula we can see two variables which are important. In the above formula we have seen that there are two variables which are important. One is standard deviation and second is weights. One is standard deviation and second is weight, and hence return has no role in the question. So it is a negative sense. Please write down the explanation that is not even given in your CFA curriculum level number 1. Please write down. Return on the asset has no impact. Return on the asset has no impact on variance on the investor's equally weighted portfolio. Question number 7. Read the question number 7 from your curriculum. A manager creates the following portfolio. The portfolio is given to me, weights are given to me, standard deviation is given to me, correlation is given to me, and I have to calculate standard deviation of a portfolio. It is very, very easy for you. I have already told you how to calculate the standard deviation of a portfolio. That is standard deviation of A1 whole square, weight of 1 whole square, plus standard deviation of 2 whole square, weight of 2 whole square, plus 2 standard deviation 1, weight 1, standard deviation 2, weight 2 into correlation between 1 and 2 under the root. So what we will be doing in the examination, some sheets are given to you in blank also. Firstly, we will calculate the actual return, actual standard deviation, and then we will see the correct answer. Sir, I did for you. Please write down. I will feel happy if you write down. Expected standard deviation of the portfolio. Expected standard deviation of the portfolio can be calculated as follows. Standard deviation 1 whole square, weight of 1 whole square, standard deviation 2 whole square, weight of 2 whole square into this, putting the figures in the calculator. Putting the figures in the calculator, I have used the calculator steps even. Point 2, then press X here because that will be, point 2. Then this is point 2. I will press X here. It will automatically come 0.04 into 0.3. Press X square because A square plus A square standard deviation square into weight square is equal to now store this in slot 1 STU1. Then go over B square 0.12 whole square, press X square into 0.7, press X square is equal to STO2. Then 2AB into correlation between A and B, 2 into 0.20 into 0.30 into 0.12 into 0.70 into 0.40 is equal to STO is equal to 3. Then I will recall 1 plus recall 2 plus recall 3. Now these all steps are not given in your answer in your CFA curriculum answer. I have given the steps. I have given the calculated steps. Then under the root, and the answer will be 12.11, and then we can take the correct answer, that is the standard deviation of portfolio will be 12.11. Now see the question again, question number 8. Investment manager creates the following portfolios with the weights of 30-70, division of this. If the covariance between this is this, the expected standard deviation. If the covariance between the security is this, the expected standard deviation of the portfolio is this. Okay, no problems. We can, even if we are given the covariance, we can easily calculate that. We know that there is a relationship between correlation and covariance. Correlation and covariance. We know that correlation is equal to covariance. Correlation between 1 and 2, that is equal to covariance between 1 and 2 upon standard deviation of 1 into standard deviation of 2. So just see in question number 8 what I have done, that standard this, and then we can calculate with the help of covariance. Now because it is given to me as covariance, so I can calculate correlation also. Just see covariance 1 and 2 into standardization of 1 into standardization of 2. So firstly I can calculate correlation, or directly I can calculate with the help of covariance also. Very easy. Question number 8 I did that. Now I am coming to question number 9. So before that I will be reading question number 9. Just see the following information. Now this is a case study and two questions are related with this. Investment manager creates the following portfolio: security 1, security 2, weights 30-70, standard deviation 20 and 12. The standard deviation of the portfolio is 14.40. Now standard deviation is given to me. Now because I know that standard deviation is calculated by this a square plus b square plus 2ab into correlation. So any missing figure I can calculate with the help of this, because it is the linear equation. We can, LHS is equal to RHS. Now if LHS is given and anything missing in RHS, I can calculate the same. So they are asking that how much is a correlation. It means deviation they have given. Now we have to calculate correlation. Very simple. I will use a formula. Just see, write the explanation. It's not given in CFA curriculum level 1. As we have discussed that R varies from -1 to +1. -1 is imperfect relationship and +1 is perfect relationship. If R is equal to -1 imperfect, then standard deviation of portfolio is 0. We have seen that if the two securities have the correlation as -1 imperfect, then the standard deviation of the portfolio will be 0. And if the correlation is +1, the highest return, the highest risk will be there. And if R is equal to +1, instead of using that big formula, I have already proved that I can calculate with the help of W1 SD1 plus W2 SD2. So I am assuming on the basis of 9th that how much is this, then standard deviation of portfolio can be calculated by this W1 SD1 plus W2 SD2. 0.3 into 0.0 plus 0.70 into 0.12, that comes to 14.4. 0.3 into 0.0 plus 0.70 into 0.12, that comes to 14.4. And last question of today's lecture is question number 10th. Just see question number 10th, and then we will be moving to next lecture. The standard deviation of a portfolio is this: covariance between the two securities. Very easy. We are given with standard deviation. We can calculate correlation, or we can also calculate covariance. That is very easy. So what I have did, just see the covariance I have calculated like this. How I have calculated? We know that this R is equal to covariance, and 1 is equal to covariance upon this standard deviation. Now the point is, because in case of perfect correlation, the R is 1, and we have already seen in the question number 9th and 10th, because they relate to the same case study. Correlation is 1. So 1 is equal to covariance 12 upon 0.20 into 0.12, that comes to 0.024. So I have calculated covariance for you, 0.024. Hope you have enjoyed the lecture. Hope you are doing the calculations with me. Please, this time will never come. Time is passing away. June and December will be coming just nearer to you. So my request to you will be, even in lecture number 9 and 10 in this practical problems, please do it along with, just read risk aversion. I have told you what is the meaning of risk aversion, and there are 3 types of investors: risk lover, risk aversion, and risk neutral. So the question is on risk aversion is best illustrated by a risk return relationship that is negative, that is neutral, that is positive. I have told you risk is independent variable and return is dependent variable. High the risk, high will be the return. But it is not same in case of all the investors. In case of risk neutral, he is only concerned with the return. He is not concerned about the risk, and that line is built parallel. In case of risk lower, more the risk, less can be the return. He is more concerned with the risk. But in case of risk aversion, high the risk, high will be the return. It means they are directly related with each other. It means they have the positive relationship. So let's see what I have shown you in this explanation. So in question number 16, there can be three types of investors. There can be three types of investors. In x-axis I have taken risk, y-axis I have taken return, and risk aversion, risk neutral, and risk lover. There are three types of investors: risk aversion, risk neutral, risk lover. Now there is a positive relationship you see in the risk and return. There is a positive relationship in risk and return. Risk averse investor will expect an increase in return with increase in risk. Risk averse investor will expect an increase in return, with increase in risk. A negative risk return relationship represents risk lower. So the question is for risk averse. So I have just shown you positive risk return relationship shows an investor is risk averse, because in case of risk averse there is a positive relationship between risk and return. So let us see question number 17. In respect to risk aversion, a risk-free asset will generate a numerical utility. That is, now what is the meaning of utility? I have told you it is a level of satisfaction which an investor is getting from buying that, from getting that return. And this utility can be calculated with the help of a formula, that is expected return minus 1 by 2 a risk aversion score into standard deviation whole square, that is variance. So I will be telling you in the explanation. Just firstly read this question. In respect to risk averse investors, it means a person is a risk averse. Now whether he is a risk averse, whether he is a risk neutral, whether he is a risk lover, all will be investing in risk free assets. A risk free asset will generate a numerical utility that is same for all the individuals. Yes, it is okay. And second option is positive for risk averse investors, and option C is equal to 0 for risk seeking investors. Now the point is, which assets are named as risk-free whose standard deviation is 0? For example, bank FD, for example, government securities, for example, treasury bills. All those securities, all those assets which have a 0 standard deviation are risk-free, and they have no correlation, and they have the same utility for risk lover, for risk neutral, and for risk averse. So please read the question again. In respect to risk averse investors, now whether that investor is a risk averse, whether that investor is the risk neutral, or whether that investor is the risk lover, a risk asset will generate a numerical utility that is same for all individuals. Only individuals can be of three types. So to my mind, option number A is correct. So I am going to explanation part, question number 17. Following are the examples of risk-free assets. Please write down. Please write down, my dear friends. Following are the examples of risk-free assets. Following are the examples of risk-free assets: bank deposit, treasury bills, government securities, and I have prepared a diagram for you also. In x-axis we will be taking risk, and in y-axis we will be taking return, and this is parallel. A risk-free asset has a variance of 0. This is very important. We all aware of that risk-free asset variance of 0 and is not dependent on whether the investor is risk neutral, risk lover, or risk averse. No, it is not dependent whether the investor is risk neutral, risk lover, or risk averse, and the variance is 0. It means it is same for all the. Hence, in respect to risk investors, a risk-free asset generate a numerical that is same for all the individuals. So it does not mean that it gives more utility to risk lover or less utility to risk neutral. It gives the same level of satisfaction to all the investors. So like this, we have covered question number 17. Question number 18. Respect to utility, the most risk averse person will have an indifference curve. Now I have told you what is the meaning of indifference curve. if a person is, high risk averse, we have done the calculation for risk averse, and risk averse can be of two types: more risk averse and low risk averse. If a person is a high more risk averse, then the indifference curve will be more higher, and if the investor is less risk averse, the more flatter indifference curve will be there. This concept I have already told you. Now read the question. In respect, the most risk averse, it means the high risk averse investor will have an indifference curve with greater slope, because it will be higher the curve, high will be the slope, so that higher indifference curve will have a higher slope. So just see the explanation which I have written for you. Risk averse investors can be, please write down. I know that you know that, but still, again, please write down. Risk averse investors can be divided into two categories: more risk averse and less risk averse. More risk averse and less risk averse. So I prepared a graph also, diagram also for you. This is indifference curve, high indifference curve. This is lower indifference curve. More risk averse and low risk averse. The higher the risk averse, it means the slope is higher in this case. If I draw a line, and if I see the angle, this angle is higher. It means the higher slope. So the same reason I have written here. Hence, risk averse investors will have an indifference curve with greatest. Hence, high risk averse. High risk averse investors, or more risk averse. More risk averse investors will have an indifference curve with greatest slope coefficient. Question number 19. Let's see the question firstly. In respect to now question number 19, 20, 21, 22, 23, all these questions are somewhat related with utility. I think I have told you about utility, but still you have to remember this formula for utility. Just I am firstly reading the question. In respect to investor utility function expressed, the utility function is expressed as this: expected return minus 1 by 2 of A into variance. Now what is A? A is risk aversion score. Which of the following values for the measure of risk aversion has the least amount of risk aversion? No. Which of the values have the least amount of risk aversion? Just read the question again. In respect to utility, which of the following values for the measure of risk aversion? For the measure of risk aversion has the least amount of risk aversion? Has the least amount of risk aversion. Just see the explanation which I have given to you. A positive value of utility is a feature of risk averse investors. A positive value of utility, if we are getting, the formula is utility is equal to expected return minus 1 by 2 into A into variance. So this is a concept. Utility is equal to expected return minus 1 by 2 into A into variance. Now if this is coming as positive, when it will come as positive? When expected return, when this part is greater than this part. Very simple. Utility can be calculated with the help of this formula: expected return minus 1 by 2 of A into variance. Now when it will be positive? When return will be more. And when return will be more, it means, the investor is more risk averse. So a positive value of investor utility function is a feature of risk averse investors. It means if a utility is coming as positive, it means the customer investor is risk averse. If it is coming as zero, it is a feature of risk neutral. It means he is only concerned with the return. If that is coming as zero, it means it is a risk neutral, and if it is coming as negative, it means it is a risk lover. Please write down these things. A negative value of investor utility function is a feature of risk lover. So in case of risk lover type of investor, there is the least amount of risk aversion. Okay, so question number 20th. The following information relates to question. Now again, there is a case study. This is the last 2 or 3 questions which we are doing in this lecture number 9, and then rest of the questions I will be doing in lecture number 10. So be sincere. Just see Be attentive in this. These 4 questions are dependent on this case study. They have given some investments, that let there be 4 investments: investment 1, investment 2, investment 3, investment 4, and the returns are given to me, and the standard deviation is given to me. And in first point, they have given the risk neutral investor is most likely to choose. And you know what is the meaning of risk neutral? He is only concerned with the return, he is not concerned with the risk, and that's why there is a straight line I have just prepared. That person is named as a risk neutral. Just read the question again before answering. 4 types of investments are there, returns are there: 18%, 19%, 20%, 18%, and deviation is there: 2, 8, 15, and 30. The highest return is in investment 3, portfolio 3. Now the point is, risk neutral investor is most likely to choose which investment. They have not given fourth, because first and fourth they have the same return, so that is a tie. So first, second, and third. So third, because in case of third there is the highest return, and risk neutral investor is only concerned with the return. So this is the correct answer. Investment 3 is the correct answer. Please write some explanation I prepared for you. A risk neutral investor. A risk neutral investor is motivated by return. He is not motivated by risk. Irrespective of the level of risk, he wants to maximize the return. So investment 3 has the highest return of 20%. So best for risk neutral investors. So it is best for risk neutral investors. So like this we have covered question number 20. So let's see question number 21 again. Investor's utility function. Again, I know that utility function is expected return minus 1 by 2 of A into variance. What is A? It is risk aversion score. And risk aversion has a value of minus 2. The risk in seeking investor is most likely to choose. Now minus 2, risk aversion is minus 2. Now what is the meaning of risk seeking? Risk lover. That the person who is more fascinated, who is more motivated with high incidence of risk. Not C. Which investment has a high incidence of risk? The C. Risk is represented by standard deviation, and in case of 4, 30 is the highest. That is in investment number 4. So without calculation also, you can easily do it. That in which case the answer will be, that answer is investment number 4, because in that case there is the highest risk of 30%. So the same thing I have written here. Risk lover investor will select the portfolio investment with the highest standard deviation. So we know that utility is equal to expected return into minus 1 by 2 A standard deviation or variance. So this is the concept which we have used for utility. And 21st question, investment 4 will be the answer. I have written there. Question number 22. Now they have given the utility and risk aversion has a value of 2. The risk aversion is most likely to choose. It means we have to firstly calculate the utility, because on the basis of utility, highest the utility, that portfolio, that investment will be selected by that investor. So just see, if I put the values as 2 in this formula, or I can use the concept also. I have written the explanation. Utility function can be, please write down, utility function can be represented as follows. Utility is equal to expected return minus 1 by 2 of A into standard deviation whole square. Investment A is 18 minus 1 by 2 of 2 into 2% whole square. So I have just calculated and I have written 17.99. Similarly, I have done for investment 2. Just I should be aware of the formula, the utility function, and I have to just put the figures. The utility function is expected return minus 1 by 2 of A, that is the aversion score, into variance. And then we can easily calculate the answer. Hope you are getting the things. Please write down the explanation, because these explanations will play a very important role in giving you success, in understanding the concepts. I have prepared only for you. Equally weighted is closest to. Now listen to me firstly. Please read the question. The two securities are uncorrelated. The two securities are uncorrelated. Now I can have a positive correlationship. For example, rainfall and sale of raincoats have a positive relationship, and rainfall and and sale of sunscreen has a negative relationship, and rainfall and rainfall and sale of calculators and rainfall and sale of calculators have no relationship, zero relationship. So they are saying there is no relationship. When I say no relationship, uncorrelated, it means R is equal to 0. So if the two securities are uncorrelated, the expected standard deviation of an equal weighted is closest to. Now I have to calculate it, but I know that if they are uncorrelated, then correlation is 0. Just see, but I have done it. Now, if the two securities are uncorrelated, please write on the explanation, sir. I have already done the hard work for you. Question number 28. Please write on the explanation. If two securities are uncorrelated, it means a correlation between two securities, that is 1 and 2, is 0. So A plus B whole square. You remember that I have given the formula A plus B whole square into correlation between 1 and 2. When I say correlation between 1 and 2 is 0, so A plus B whole square is equal to A square plus B square plus 2AB into correlation. That third term will be 0. I am only left with A square plus B square under the root. So the same thing I have done here. Just see, standard deviation of 1 whole square, W1 whole square plus standard deviation of 2 whole square into W of 2 whole square. I have just fed the figures. And now this whole process has not been given in your CFA curriculum solutions. I have seen that. So I have given you in the simple form. Even the steps I have given to you, and that comes to 14.14%. So I am coming to question number 29th. Let's see question number 29th. What this question is saying to us. The number of assets in an equally weighted portfolio. The point is, equally means all assets are equally bifurcated. Supposing there are 10 assets, then 1/10, 1/10, 1/10, 1/10, 1/10, 1/10, 1/10, 1/10, 1/10, 1/10. This is named as equally weighted portfolio. You're getting a point? Equal weights. The number of assets in an equally weighted portfolio increases. It means if I increase, if it is this portfolio is of 10 assets, and this portfolio of 20 assets, and this portfolio of 30 assets, and this portfolio of 40 assets, it means I am increasing the number of assets. Now in this portfolio having 40 assets, all the assets will be having the proportion of 1/40, 1/40, 1/40, 1/40, and the risk will be very much lower in this case because I have used the benefit of diversification. So I don't know what the question is saying, but I am just telling you what is the meaning of this. The number of assets in the equally weighted portfolio increases. So if we increase the number of assets in a portfolio, the contribution of each individual assets variance to the volatility of the portfolio. It means because each asset we are increasing, and it is increasing the volatility of a portfolio. But if more number of assets are there, then the standard deviation of the total portfolio will decrease. So this is B point will be the answer. Just we see what is I have written. So I have written a flow chart for you. Question number 29. As number of securities being increases in a portfolio, risk is high and risk is less. Just see, as the number of securities in increases in a portfolio, here risk is high and here risk is less. Why? Because here I have written dots are assets, and here dots are again assets. More assets, more benefits of diversification. Hence, the contribution of each individual asset variance to the portfolio variability decreases, which is also named as benefits of diversification. So, as I increase the more number of assets, then it will have it will have more benefits of diversification. You're getting a point? So I have written that question number 30th. Just see to it. What question number 30th is saying to us. That's why I'm telling you that please read the question before taking this class, because then your concept will be more clear. In respect to equally weighted portfolio made up of large number of assets, which of the following contributes to the most of the volatility of the portfolio? Volatility. When I say volatility, it means risk. When I say risk, it means standard deviation. When I say standard deviation, it means variance. So all these are words which are correlated. Now in an asset, in a portfolio, there can be different assets. Now, if this asset and this asset has some relationship between them, if they have positive relationship, then risk will be high. And if this asset and this asset has a negative relationship with them, then the risk is less. Okay, you are getting this? And just see to it what the question is saying. In respect to an equally weighted portfolio made up of large number of assets, which of the following contributes the most to the volatility of the portfolio? A. Average variance. Standard deviation, standard deviation is a net result. Average variance is the net result. Average covariance between all the pairs of the assets. Yes, C is the answer, because the covariance between the assets and then the correlation between the assets, that plays a very important role in contributing the deviation or contributing the volatility of a portfolio. So question number 30th, answer number C is there. Just see to it. Risk slash volatility of the portfolio is directly related with the relationship. Risk slash volatility of the portfolio is directly related with the relationship between the securities. Now relationship can be positive, relationship can be negative, or relationship can be zero. Now relationship can be estimated with the help of two tools, covariance and correlation. I have already explained, but still I have given the explanation so that you can get an idea that what I want to say. Hence, average covariance between all the pairs of assets plays an important role. So, covariance is the answer. So, I am coming to question number 31. Now, total I have to do 40 questions. I am in question number 31. Correlation between assets in a two asset portfolio increases during a market decline. Yes, we have done this. When it is a case of financial crisis in 2008, whenever there was a financial crisis, the correlation between the asset increases. It means all the assets will decrease, whether it is a case of alternative assets or whether it is a case of equity, whether it is a case of traditional, all will decrease. So by that I mean they have a direct correlation in case of financial crisis. You see again, correlation between assets in a two asset portfolio. There are two assets, increases. The correlation between these two assets increases as a market decline. If there is no change in the proportion of each asset, if there is no change in the proportion of each asset held in the portfolio or expected standard deviation of the asset, the volatility of the portfolio is most likely to. We know that when the correlation increases, risk increases. Increase, decrease, retain, remain same. Increase, it is but obvious that it will increase. Just see to me. In the period, just write down, in 2008 there was a financial crisis. In the period of financial crisis, the correlation between the asset increases. This is the exception, diversification exception we have done in one lecture. In the period of financial crisis, the correlation between the asset increases, and the correlation can be from -1 to +1. As R increases, it implies assets will increase or decrease in the same direction. Assets will increase or decrease in the same direction. Hence, portfolio risk will increase. So, question number 32, 32, 32, 32, 32. Now 32, 33 and 34 depends upon a case study. I am given with a case study. 3 assets are given to me, 1, 2 and 3. 3 outcomes are given to me, and then the average of that, returns are given to me. Just read it carefully. An analyst has made the following return projections. An analyst like you has calculated the following return projections in 3 possible outcomes, that if this happens, if this scenario is there, then this will be the return. If this scenario is there, then this will be the return. If this scenario is there, then this will be the return. All different scenarios, different returns are given to me, and the at last expected return is 6, 6, 6, 12 plus 0 plus 6, 18 upon 3, 6, 12 plus 6, 18 upon 3, 6, 6 plus 12, 18 upon 3, 6. So these are the different, outcomes are given to me, and you just see to it. Don't go in question number 32, just see the table. Asset 1, 2, 3, outcome 1, 2, 3, 12%, 0%, 6%, 12%, 6%, 0%, 0%, 6%, 12%. Just see it carefully. That asset 1 return is 12%. Then asset 2, outcome 1 only, asset 2 return is 12%. But in asset 3 return is 0%. It means asset 1 and 2 are directly related to some extent. Okay. In outcome 2, asset 1 return decreases from 12 to 0 and asset 2 return also decreases from 12 to 6. It means both are decreasing. It means asset 1 and 2 have a positive covariance, I can say. Now in outcome 3, just see to 1 and 2 only. In outcome 3, asset 1 return decreases from 12 to 6 and asset 2 decreases from 12 to 0. It means asset 1 and 2 have a positive relationship. But if I compare with 2 and 3, just see, in outcome 1 it is 12%, but for asset 3 it is 0. It means there is an indirect relationship. In outcome 2, 6 and 6, and in outcome 3, 0 and 12. It means asset 2 and 3 are negatively correlated. You are watching that, you are realizing that. So I will be comparing two sets, 1 and 2, then 2 and 3, then 1 and 3, and then I will find out their relationship, and then I will answer these question number 32, 33, and 34. Now see question number 32. Pair of assets perfectly negative correlated. So the question is, which pair of assets, either 1 or 2 or 2 or 3 or 1 or 3, which are negatively correlated? Negatively correlated, perfectly negatively correlated. Perfect means R is -1, imperfect relationship. Then when this asset increases, this asset will decrease, and when this asset decreases, this asset will increase. So just see asset 2 and 3. Just see asset 2 and 3, asset 2 and 3, and compare the outcome 1, outcome 2, outcome 3. There is a negative correlation, and that is imperfect correlation between asset 2 and asset 3. Just see to it. So this will be the answer. Now I have written somewhere some explanation also. Question number 32. Just write down the movement in the returns of the asset can tell us the relationship between the assets. The movement in the asset returns, the movement in the returns of the asset, the movement in the returns of the asset, the movement in the return of the assets can tell us the relationship between the assets. If returns of the asset increases in the same outcome, then it implies assets are positively correlated. If the asset returns move in different direction, it means one is increasing, other is decreasing. If both are increasing, both are decreasing, it means they are positively related. If one is increasing, other is decreasing in different direction, then it implies assets are negatively related. So asset 2 and 3 have a negative correlation, that we can also prima facie it can be seen also. So I am in question number now 33. And similarly 33 and 34 we can answer on the same basis. So I am moving to 33, 34. I am directly coming to 35 now. The following statement is least accurate. Least means it is a negative sense. So before answering, be careful that the question is least accurate. The efficient frontier is the set of all attainable risky assets with. Now, what is the efficient frontier? I have told you before that we have to prepare minimum variance portfolio, and that minimum variance portfolio for a given level of return, we will choose a portfolio with the lowest risk, lowest variance. So, and that point is named as global minimum variance portfolio. And above that global minimum variance portfolio, we will select that frontier is named as efficient frontier because at a given level of risk, we will have a maximum return. So it means minimum variance portfolio tells us that at a given level of return we will have minimum variance, and efficient frontier tells us that at a given level of risk we will have a maximum return. It means they are talking about something like this. Okay, so a higher expected return for a given level of risk, lowest amount of risk for a given level of return. A and B are saying as per efficient frontier, but we have to answer least likely. Highest expected return related to risk-free rate. The point is, in case of minimum variance portfolio and efficient frontier, we have not even touched the risk-free rate. It is only at the time of indifference curve. It is only at the time of capital allocation line we have touched that risk-free rate is also there. So C is not correct. A and B are correct, and the question is in the negative sense. So C is the answer. Just see what I have written in question number 36. 35th. Efficient frontier can be drawn with the help of minimum variance frontier. We know that. And this is the main. I have told you the graph also. This is bullet shape, and the point of this bullet is named as global minimum variance portfolio. And then we can draw the efficient portfolio that is over and above that global minimum point. And in efficient frontier or in minimum variance, we are talking of given risk or given return. So nowhere we are talking of risk-free rate. So I have given you the answer. Question number 36. So I have moved to question 36 now. On the minimum variance portfolio, the lowest standard deviation is global minimum variance portfolio. We know that. The lowest point, that tip of that bullet is minimum variance portfolio. Just see to it. The following is a flow chart of minimum variance portfolio, and this is bullet form, then the tip of that global minimum portfolio. So we are all aware of very simple question number 37. The set of portfolios in the minimum variance frontier that determines all set of portfolios given that this it is not the capital allocation line. Capital allocation line is the indifference curve when risk-free asset is being increased. It is not the set of optimum risky portfolios. Rather, it is a Markowitz efficient frontier. So just read the question again. Set of portfolio on the minimum variance frontier. With the help of minimum variance frontier, we can calculate efficient frontier. That dominates all, which dominates all. It means the topmost point of global minimum. That is efficient frontier. Just see to it. This is question number 37. This is question number 37. This is global minimum, and this is efficient frontier. That is over and above the global minimum variance. So I think I have answered the question. Question 38. Dominant allocation line is the combination of risk-free rate and the optimum risky portfolio. 38. Indifference curves. Then firstly I have drawn the indifference curves. Then with the help of these indifference curves can be converted to capital allocation line when I add that risk-free asset within that. Just have added risk-free assets, then it will be capital allocation line. Now the point is, whether I will be on CL1, CL2 or CL3, it depends upon my preferences of the investor, that how much he wants to take the risk. So again, I am reading question 38 for you, that what this question is saying to us. Dominant capital allocation line is the combination of risk-free asset and the optimum risky portfolio, levered portfolio of risky assets, global minimum variance portfolio. It is optimum risky portfolio. So I am coming to question number 39. The efficient frontier of risky assets. The dominant capital allocation line has a high rate of return for levels of risk greater than the optimum risky portfolio because the investor utility ability to now the point is, I have told you there can be a lending portfolio, there can be a borrowing portfolio. Borrowing will be above market optimum market portfolio, and lending will be below that. That line is named as capital allocation line. When I say borrowing, it means the person investor is borrowing. Firstly, he is using 100% of his own funds. Along with that, he is borrowing from risk-free asset, and he is investing in the market in the risky assets. It means he's getting more than that, more than that. So it is a case of borrowing. When we are getting the more return from as compared to the optimum market portfolio, it means we are borrowing at risk-free rate. So question number 40th, the last question. In respect to the minimum variance theory, the optimum portfolio is determined by individuals' preferences. Because when I say minimum variance, it means at a given level of return, we will be having this much, we will be having lower risk. Then we have drawn the efficient frontier, and then with the help of efficient frontier, we have drawn after that we have drawn the capital allocation indifference curve, then capital allocation line. Now there can be different capital allocation lines. It depends on the preferences. So at last, we have seen that it depends on the investor's preferences. Just see the explanation which I have written for that. 39. Please prepare a graph. I have prepared a graph. This explanation is not given in your CFA curriculum. I have prepared the flow charts. I have given the explanation as per the concept which I have told you in the lectures. So this is capital allocation line. That part is borrowing. This part is lending. This part is market portfolio. It means if I am in this part, it means I am earning more. Then the market portfolio, because I am borrowing from risk-free rate and then I am investing in the market, and the return on the market is always more than risk-free rate. Question number 40th. I have already explained you, but just write down the explanation I have prepared for you. Now, when we combine risk-free assets along with risky assets, then capital allocation line succeeds in difference curve. We are all aware of. Firstly, we have seen what is the meaning of indifference curve. Then we have seen that higher indifference curve will give more satisfaction for a given level of risk. And then we have added risk-free assets, and with the help of that, we have prepared a characteristic, we have prepared a capital allocation line on the for indifference curve. And the higher capital allocation line will give more preference. It depends upon the investor's ability and willingness to take the risk. So please write in question number 40th. When we combine risk-free asset along with risky asset, then capital allocation line succeeds in difference curve, and now higher indifference curve gives higher level of satisfaction to the same level at the same level of risk. This is very important. No doubt, higher indifference curve gives as the higher satisfaction, but at the same level of risk. Now, at which indifference curve investor wants? It depends upon his preferences. So like this, I have covered 40 questions of portfolio risk and return. Hope you have enjoyed, and you must have done along with the calculators. Be happy. Be